Well, hi, everybody. I'm Rick Edelman. Thanks so much for joining us today for this really fascinating and important conversation, getting Bitcoin exposure beyond the spot ETFs. There's a whole lot out there that you probably are not familiar with, and we're going to reveal it all to you here today. And joining me in this conversation is Dave Laval. He is the global head of ETFs at Grayscale, who's been in this industry a really long time. Dave, thanks so much for joining us in this webinar today.
Rick, it's great to be here. Thanks for having us.
Well, I'm going to ask you a rather silly question because I don't think it really needs much of an answer, but I'm going to ask you to do it anyway, and that is to describe Grayscale. Grayscale, of course, the largest, I think, pure crypto asset manager out there, certainly one of the oldest. Tell us about Grayscale.
Yeah, we are the largest dedicated crypto asset manager in the world. We were founded in 2013. We have over 22 billion in assets. I think that most people know us for our flagship Bitcoin products. We have 4 dedicated digital asset ETPs in market, 2 based on Bitcoin, 2 based on Ethereum. We have a few equity and options-based traditional 40 Act ETPs in market as well, which I'm sure we'll talk about today. But we also have a large swath of private funds, and we're 100% dedicated to crypto. We're really proud of that.
Well, the one thing I need to point out, because you're going to be too modest to do so, if it wasn't for Grayscale, none of the Bitcoin ETFs or any other ETFs that have followed, none of them would exist, be on the market today. What I think a lot of folks sometimes forget, or many don't even know, is that it was Grayscale that filed the lawsuit against the SEC after the SEC had continually persisted in rejecting the applications to bring a Bitcoin ETF to the marketplace. It was your lawsuit that forced Gary Gensler to bring the ETFs to market January 10, a year ago. And look where we are today. Pretty astonishing impact that Grayscale has had on the investing public.
Well, we really appreciate you saying that, Rick. Look, you and I have both been in the market a while. We've both been following the trajectory of the ETF market. It was 2013 when I was at NASDAQ when I first contemplated trying to bring a spot Bitcoin ETP to market. And, roughly 10 years later, kind of full circle, having the opportunity to really partner not only with, asset managers, but also with every large institution that's supporting the infrastructure. So admin and market makers and APs, liquidity providers, everyone really showed up to make it work. And it's been really a testament to the entire industry. But it's really about bringing an exposure to clients and, giving them what they have desired. So the astronomical asset growth has been a real testament to, the desire that investors of all shapes and sizes have for digital assets and Bitcoin in particular. And then also a real validation for the asset.
I've worked with Grayscale since pretty much its beginning. I got involved in crypto back in 2012. Grayscale launched in 2013, a true pioneer in the industry. And that's why you're not just the earliest, but the largest crypto asset provider today. And so, you're the elephant in the room, and deservedly so. So I've got a bunch of questions I want to ask you, Dave. And I invite all of you to join in as well. Many of you have submitted questions in advance when you registered. I will pepper those to Dave as we go through this conversation. And you're welcome to ask additional questions. If something you hear us talk about perks something in your mind, go to the Q&A box here in Zoom. I'll be curating that as we go. And if I see something there that looks on point, I'll toss it over to Dave. But Dave, before we get into what folks had already previously asked, I've got to talk about the last 3 days. Obviously, the investing world has gone topsy-turvy, and that persists as we conduct this event today. Give us your insight, overview, outlook, thoughts. Well, I don't even know how to frame it. I don't think anybody knows how to frame it. Tell us about your views of these past 3 days.
Yeah, I mean, look, this market that we've seen over the past couple of days and some of the, real kind of sharp volatility, especially yesterday morning that we saw, and coming off a weekend and a lot of kind of conjecture in the market. It actually really harkened back to, 2008 timeframes in terms of the volatility that we're seeing, let some limit down and then really, sharp spikes up on news, and then sharp spikes down again. I think the reality is you take a look at, S&P, you take a look at NASDAQ 100, you take a look at bond yields, the 10-year, and then you take a look at Bitcoin. And honestly, on a relative spectrum, obviously there's been some intraday volatility, but on a relative basis, Bitcoin over the past few days has kind of been range bound from, let's say on the top end, 82, 83,000, on the bottom end, right around 75,000. And so, on a relative basis, it's kind of been an asset that has been uncorrelated to, the broader markets. And, there have been times when, Bitcoin has been more correlated to tech. And there have been times when Bitcoin has been more correlated to gold. And then there have been times when, Bitcoin has been, a more uncorrelated asset and something that investors can really rely upon to be a bit of a safe haven. And I think over the past few days, it's something that we have been seeing and witnessing real time amid some real volatility that has been brought on, I think, just generally by tremendous uncertainty in the marketplace. I mean, we talk about it as investors and as asset managers and kind of, risk takers and risk managers. Uncertainty in the marketplace is very, very difficult to manage. And amidst this uncertainty, this asset that is, uncorrelated and kind of totally X the system, so to speak, has remained somewhat objective and has not been, hit by the perils of this volatility.
I'm going to ask you to play with your microphone like you did a little bit earlier. If you unplug it and plug it back in, see if we can improve that sound a little bit. And while you're doing that, I'll pose this question to you that, pre-January of 24, before the ETFs came onto the market,
right,
buying Bitcoin was a nuisance. It was difficult. It was cumbersome, complicated, intimidating for a lot of first timers, and it kept a lot of people out of the market. Now the ETFs are on the scene, and it's understandable why investors threw $100 billion at them, because the ETFs make it so incredibly easy and simple, right, and familiar and non-threatening in that familiarity sort of way. Adding it to a simple ordinary brokerage account where you can rebalance and dollar cost average and tax loss harvest. I mean, what's not to love? So given the availability of those ETFs, and of course, Grayscale was among the first 9 that were launched. As I said, it hadn't been for you, none of this would be the case. But now that they're here, why would anybody want to gain Bitcoin any other way? Because this seminar is designed about talking about gaining exposure beyond the ETFs. Why would we want to bother doing that?
I mean, Rick, I always use the analogy of gold. And I think it's a really good analogy to use. Different investors want their exposure in different ways. And, some gold investors want to have gold in their vault, and they want to make sure that it's on their premises and in their home so that they can, hold it and safekeep it and, take care of the security of it. And it gives them a certain level of comfort. And others, want a financial product where they can take advantage of it being alongside all their other investments in their brokerage account. And then others want, some other synthetic form or some other synthetic exposure to it, whether it's in the form of a future or another financial product. And then others want, some sort of equity representation, maybe in the form of, a gold mining ETP. And so I think, it just is a matter of your preference as an investor and exactly how you want to realize that exposure. And I think the very same is true for Bitcoin. And, there's a lot of options that have really been brought to market more recently. And look, in the very beginning, before the exchange traded products were launched and listed, it was actually really some of the innovation at Grayscale that allowed for investors to, gain exposure to Bitcoin and put it in their, retirement accounts and take advantage of some tax deferral. Now that the ETPs are here and we've had a little bit of kind of, I would say, maturation of, the exchange traded product marketplace for digital assets, this is no longer kind of a binary decision. Do I want Bitcoin or do I not want Bitcoin? It's a more sophisticated question that investors are, having with themselves or having with their financial advisors and talking about the best way that they can, have digital assets in their portfolio, but also supplement their, broader investment and financial goals.
Yeah, I get, that's undeniable. I have to say that makes sense. If you really think about it, financial advisors, and I think investors generally, love diversification.
Right.
Well, we all know why. We don't have to delve into that here. But when you really look at it, those Bitcoin ETFs are a single asset investment, which is contradictory to the diversification approach that advisors take. So, yeah, we like Bitcoin and yeah, we like crypto, but a Bitcoin ETF is just Bitcoin. It
Yeah.
doesn't provide income. It doesn't have any hedge, against downside. Um, so it makes sense to look beyond the Bitcoin ETFs to allow you to fulfill your portfolio modeling objectives in a manner that the Bitcoin ETFs just essentially can't.
Yeah.
And so now we're seeing a raft of ETFs in the marketplace and other investing strategies. So talk about them. Give us some detail of those alternative ways that we can get exposure.
Well, I'm actually going to go back to the conversation with advisors first. And, we've been talking to advisors for a very long time. And before the Bitcoin exchange traded products were in market, advisors really had no way to gain access or exposure to Bitcoin on their investment platforms. And so largely advisors were kind of forced to, send their investors or their clients to another place to gain, exposure to digital assets.
Right.
And furthermore, we kind of saw advisors, realizing this kind of asymmetric downside risk to making a recommendation or an allocation to Bitcoin or digital assets. And so they weren't doing that. With the advent of the exchange traded products coming to market, Rick, we saw a total inversion of the asymmetric risk. Now advisors had an asymmetric risk if they didn't have a strategy around digital assets, because now there were ETFs. Now they had the ability to kind of offer it to their clients. Now clients knew that they could get access to Bitcoin in a very familiar wrapper and kind of make that allocation alongside all of their other ETFs or investments in their portfolio. And so this isn't to say that every single investor needs an allocation to Bitcoin. That's not my point. My point is that advisors recognized they had an asymmetric risk to their franchise if they didn't have a strategy around it. So the conversation with advisors really changed, which is largely what led to some of the proliferation of different types of products. And, I always have said, if there's one thing that I can't predict as a 20-year ETF veteran, I can't predict what is going to be, a good successful launch versus an unsuccessful launch. The ones that I think are going to be big have maybe not been successful. The ones that I think aren't going to be so great have been really successful. But when you listen to your client and you listen to the advisor and you listen to the solution that they're looking to solve for, it becomes a little bit easier to actually product develop. And that's why we have brought a couple of different, kind of solutions to market. Number one, an equity representation of, Bitcoin or digital assets. We have a miners product. This is something that, is really just taking advantage of that, analogy that I used earlier, which is we would have conversations with advisors and say, you should really make an allocation to Bitcoin. They would say, we would really love to make an allocation to Bitcoin. My clients aren't quite ready to jump into the digital asset directly. What do you have that's an equity representation of that? Or we would have advisors that would say, I'm ready for that, but my platform is not ready for that. We haven't onboarded these products yet. We're not permitted to have these products onboarded yet. What do you have in an equity, variation of that that's going to give me high levels of correlation to the underlying performance of Bitcoin, but is, in the form of a basket of equities? And so we launched our miners product. And that has been, fairly successful and very well received by our clients. And furthermore, the next conversation that we were having is, we're looking for a little bit of downside protection. We want a little bit of like the upside performance. We're okay to cap the upside performance. We'd love to have some sort of income story with Bitcoin. Like, what can you solve for? And that's really when we just took a page from, traditional finance and decided to come out with a couple of variations of covered call products. And these covered call products are taking advantage of, the options that are based on Bitcoin exchange traded products. And we have a couple of variations of that. Sell, traditional covered call products, sell at the money calls, capture that premium. And look, Rick, with the level of volatility that you have with Bitcoin, it offers really attractive premiums. Because obviously, options pricing is based upon volatility, and the higher the volatility, the more premium you're going to be able to capture. And so we've been really excited about having recently launched our, Bitcoin covered call product. And then further, some clients said, but we don't totally want to give up all of our upside. Can you give us something that gives us some upside, but still offers the opportunity to capture some, yield and some income. And so we have our premium income product, which goes 15-20% out of the money, sells those calls. So as the investor, you get 15-20% of upside capture of capital appreciation of the underlying asset. But at the same time, that's in exchange for slightly less income. And so we're super excited to have brought these products to market. Our sales team, the day we launched, I hadn't heard the phones ringing as much and these guys chattering as much with clients. People are really excited about it, and we really are too.
And I think it's because the ETF industry, let's face it, is a really good manufacturer of investment opportunities. And so the Bitcoin ETFs a year ago were just the beginning. And
Right.
now that you have the ability to generate yield off of Bitcoin is something that couldn't be done for the first 14 years of its life.
That's
The
right.
fact that you can now structure it to reduce the volatility that Bitcoin is infamous for is something that really couldn't be done before. And it's because the options market is now so huge. And that's because of the ETFs that were launched in January of 14. That created the options market
Exactly.
that is unprecedented. So
Exactly.
I think most advisors are not really paying a lot of attention to that at the speed of which this marketplace has grown and developed. Would you agree with that?
Yeah, I would totally agree. And again, back to my point, the beginning of last year, it was a very binary decision, yes or no to Bitcoin. And as time has gone on, I think the old adage that I've been saying for 15, 20 years, not every ETF issuer is created equally. Not every ETF product is created equally. Some of the nuances associated with bringing this new asset class into an ETP wrapper are really starting to kind of unfold, and you're kind of appreciating some of the benefits or drawbacks of certain products. And then furthermore, we're not just going from kind of 0 to 1 on this decision on making allocation. One of the more sophisticated ways that we can kind of enhance the client's portfolio. How can we generate some income? How can we give ourselves some downside protection? How can we make the most educated decision on how to incorporate digital assets into a client's portfolio? And I think, most people were just saying, okay, this is, some sort of, a digital store of value akin to gold. Well, truthfully, sometimes it has, the behavior of, really transformative technology. And so somebody that was really only interested in kind of, some sort of store of value, so an advisor might be making an allocation, pulling a little gold back, putting a little Bitcoin in. Well, now they're thinking about small cap tech. Maybe I pull back a little bit on my small cap tech and I incorporate some Bitcoin into it. So people are appreciating the different kind of use cases and the different spots in a client's portfolio where Bitcoin might fit. And then furthermore, figuring out if they want to take advantage of some of the other kind of exposure choices, allowing for, the opportunity for some income and a little bit of downside protection as well.
I'll ask you to play with your mic once more for me, Dave.
Sorry about that, Rick.
That's quite all right. So delve into the detail for us and talk about the portfolio construction. How do you, and the diversification strategies along with it, are you seeing advisors using these new option strategy ETFs that are available?
Yeah, it's a little bit early, but what we have seen is we have really taken advantage of having conversations with advisors who have an angle or a bent towards generating yield. When you take a look at, and obviously we're making some, pretty broad generalizations here, those investors that are kind of, later in the cycle of their investing kind of life, maybe retired, maybe focusing on yield generation, income generation, are not necessarily interested in taking advantage of a 50, 60, 70 vol asset class. Well, when you start incorporating these type of products into clients' portfolios that are looking for yield, all of a sudden you can have participation in an asset that has some upside potential, capital appreciation, but also generating some really significant yield based upon the fact that it's taking advantage of a really volatile asset class and selling those options against it. So, I mean, look, it's early in the product's life cycle. We're yet to have a distribution yet. It's going to be making monthly distributions. Where it's an actively managed product. We're working very closely with our sub-advisor, working very closely with our index provider, SIBO, to make sure that that we're managing it appropriately. And typically, when these products have come to market in other asset classes or tracking other indexes, after that first distribution, you can really see the assets and the volumes take off, and we're really, really excited. So we're managing the product. Everything is going smoothly. This, bout of volatility over the past few days, hasn't wavered our confidence in the ability to manage the product, and has only given us an opportunity to harvest more yield. So we're super excited about it.
So talk about it from a practical perspective, from the advisor's lens, in terms of potential returns. What do you see as the difference between Bitcoin equities and options from these spot ETFs?
Yeah, well, look, it's hard to know. What I would say is, if you feel like you're in a range bound scenario on the asset, you're not kind of up and to the right, you really have an opportunity to generate that yield, because you're not really kind of giving up any upside performance in the underlying asset. In an up and to the right scenario, you're going to underperform the asset, but you're going to generate that yield. And in a downward market, you're going to outperform the market, because presumably you're going to be capturing that yield, and that's not going to, it's obviously going to cut into any sort of loss that you have. So it's honestly, covered call strategies are something that have been in the market for a very, very long time. I think you and I would remember when they first, came out in the form of closed-end funds. And then, over time, like every other kind of strategy, have really been adopted in the ETP wrapper, which again has democratized that type of exposure. Right. And clients have been utilizing options-based strategies, covered calls, buffered notes, target date, target outcome, strategies in the ETP wrapper. And we're seeing the same with Bitcoin now.
And that's kind of, I think, the key point, isn't it? That these products may seem new and different and untested, but in fact, they're simply doing in Bitcoin what the stock market's been doing for decades.
That's correct.
There's no difference here. And so you don't have to look at these ETFs and say, oh, they're so new, I want to give them time. There's nothing new here. It's just being applied to an asset it hasn't been applied to before. So
yeah, and the only difference is as volatile as any other asset class that they have, put these strategies on, is likely lower than what we have in Bitcoin. And therefore that, increase in volatility for the Bitcoin underlying asset generates higher yields. So it's an exciting opportunity to take advantage of Bitcoin's volatility, when typically Bitcoin is, kind of charged with being a volatile asset that's too volatile for a client's portfolio. In this case, it has the same volatility, but it has some positive outcomes for clients.
And I find that really interesting about the buffer perspective, the ability to insulate yourself from some of the downside risk. Because let's face it, that's the number one thing that's keeping a lot of advisors and a lot of investors out of Bitcoin. They've seen the 70% drawdowns that have occurred how many times now? 4 times?
Yeah.
And people don't want that exposure. But now you can say, well, we can insulate you against that. You'll give up a little bit of the upside, but the upside is so huge in its potential, giving up a little bit of it isn't that big a deal compared to insulating yourself against the large downside risk. And it allows people to engage in Bitcoin who before emotionally couldn't bring themselves to do so.
Yeah, one of the things, Rick, how many times have you and I talked about ETFs democratizing an asset class, but largely that has been an institutional grade strategy that has then been brought to the masses. One of the things that's a little bit different about Bitcoin that we talked about is it's more of a barbell approach, where you have, initially had, single, small scale retail enthusiast investors on the one extreme to the left, and all the way to the right, the most sophisticated institutions in the world that were willing to self-custody and do the homework and read the white paper. And in those instances, those are people that were looking for, 5x, 10x, 15x, 20x, 50x on their return profile. And now as the, asset has matured, we now have an ETF, ETFs in market, we're starting to kind of narrow the focus on what individuals' kind of return expectations are. And as we kind of, address the advised market, we're having very different conversations about how clients want to make an allocation into their portfolio. And they're really not necessarily looking for the 10x return, because they know that comes with, some downside potential as well. So having the opportunity to kind of scale that back and deliver Bitcoin with some upside while giving that benefit of yield and some income is a story that's really resonating with the broad range of clients.
talk about that market volatility in the context of what's going on at the SEC, the regulatory changes that are being signaled out of the new administration and the new leadership of the SEC on these alternative Bitcoin exposures. Talk about that.
Well, I'm going to answer that in a handful of different ways, Rick. I think, we have seen a new administration that is certainly much more favorable towards digital assets broadly, but it has been a bit more uncertain. And previously, we had a very certain environment that was really unfavorable. So I will take what we have now. It's certainly much more favorable, but there's certainly an element of uncertainty that we're dealing with. The way that we have approached that is to essentially say, you know what, everything is ultimately going to get approved at some point in time. We have an SEC that is having very favorable, very constructive conversations with us on a number of different topics, in-kind creation redemption, how can we get staking into Ethereum? We have executive order coming out of the White House. We have the crypto task force that is engaging with a broad range of the industry. So we have just a much more favorable, collegial approach to trying to solve problems that the digital asset marketplace is facing. There's a request for comment out. I mean, it was hundreds of questions, trying to address some of the most basic concerns that the market has. Is something a security? Is something not a security? What jurisdiction is it falling under? Is it the SEC? Is it the CFTC? And so I think this is, we're in this kind of uncertain phase, but we recognize it's much more favorable, and we recognize we're making really material steps going forward. I think the focus was largely on, President Trump being somebody who is very, favorable towards crypto and wanted the U.S. to be kind of the crypto capital of the world. But it also went to, many different races within, Congress. And crypto became something that voters were focused on. And so now we see this kind of progression over the past 4 years that I've been at Grayscale, going from crypto being a partisan issue to then crypto being a bipartisan issue, and then ultimately crypto being a nonpartisan issue. And, for all of my colleagues who are spending time down in DC, and for all the conversations we're having in DC, this concept of it being nonpartisan is really the most bullish indicator that we have seen. And I think we're going to see some not only kind of regulatory clarity at the SEC, we're also going to get some, clarity on rulemaking and clarity on some policy as well.
That's really profound. I hadn't heard it phrased in quite that way. That nonpartisan angle, I think, is really astute and speaks volumes as to what we are going to be seeing over the next couple of years out of Washington. So with all of that combined, Dave, what then should advisors be thinking about when talking to clients about this broad subject, crypto equities, crypto spot, crypto options? What should advisors be telling clients?
I mean, first of all, advisors need to recognize that it's time to get educated. And I'm going to, take a page out of my exchange traded fund book. And I think that you'll appreciate this. Listen, it was late 90s, early 2000s. I was trading on the floor of the American Stock Exchange, and the vast majority of the tickers that were going across the tape were SPY, QQQ, DIA, MDY, and a handful of other of the, the earliest exchange traded funds. The crowds with the smartest people and the best traders were all in, the ETF pits. And that was where it tipped my hat. Maybe I should learn a little bit about this. And, when you became an ETF kind of expert in the early 2000s, you were a little bit unpopular, so to speak.
Yeah.
And you were kind of bucking the trend. But once we got to like 2007, 2008, and you kind of had repeated conversations with advisors, they kind of realized, wait a minute, these things are not going anywhere. Maybe these things are not, financial weapons of mass destruction. Hey, maybe these concepts of transparency and tax efficiency and, ability to have, really useful, capabilities, building blocks in my portfolio for a number of different assets is kind of true. They started to open their eyes and broaden their exposure and be more open-minded to this transformative technology that was the ETF. And that was 15 years into ETFs being in market.
Yeah.
We're coming up on 10, 12, 15 years on crypto being in market, and we're seeing a similar shift. And so I would I always say to advisors that I talk to, remember how long it took you to get comfortable with ETFs, and when you started to incorporate ETFs into your clients' portfolios and what benefit it was. And that's because you were talking to experts about how to educate oneself on how ETFs work, how they can incorporate them into their clients' portfolios. I think we're at this same inflection point right now, Rick. And it's an open-mindedness, an ability to be educated, to ask thoughtful questions, to not be afraid to ask those questions, and to really face off with the experts in the industry, because you're going to bring real value to your clients. And listen, that is not to say, I'll repeat it, not every client should have an allocation to Bitcoin. It's just not the case. But you have options out there to get exposure to digital assets that fit your individual client's needs, and to make a thoughtful and appropriate, allocation. And furthermore, this is something that has really been coming up with succession planning. We've got 80 trillion in wealth that is going to, generationally transfer in the next 15 or 20 years. I can guarantee you that next generation is going to want to, be certain that you have intelligence, have been educated, and have a strategy around digital assets. And when we talk to advisors about that, that's mostly when we see the brightest light bulb kind of go off above their head. Ooh, this is true. We need to make sure that we're appropriately planning. The Bitcoin ETFs have been an inflection point. It's opened many people's eyes. The onboarding at the wirehouses and some of the largest wealth management platforms, independent or otherwise, have really been a second inflection point for these advisors. And we're having really, really thoughtful conversations with clients about it. What they should do is they should educate themselves. They should understand what's out there. They should talk to, firms like Grayscale. Info@grayscale.com, or just pick up the phone and call us. We've got, troves of people that are excited to talk about digital assets and walk you, meet you wherever you are on that journey, and then deliver a solution that fits your clients' needs and your, clients' portfolios.
Once more with your mic. That was really well articulated of what advisors should be doing. But I want to just ask you a bit of a challenging question. You talk with advisors all the time. Are they doing that? Are advisors behaving in that way, which frankly strikes me as the fiduciary approach they ought to be taking? But are they in fact doing so, or are they generally saying, I don't care, I got plenty of other things to do, my practice is fine, my clients are happy, I don't care, I'm not going to fuss with it? What are you hearing?
I think we're closer to 2003, 2004 in ETF land than we are in 2008, 2010 ETF land. But I will tell you that the conversations are super exciting. I could give you a host of different, metrics, but one of the things that we've been doing, we've been having these regional events. I mean, listen, you're such a great advocate for digital assets, and, webinars like this and all your advocacy, and, really making sure you're targeting, the advisor community. We're doing the same thing with our regional events. Those events have gone from 25 people to 50 people to 80 people to 100 people to oversubscribed. When we go and we show up at, events that are a mixture of, kind of large scale ETF events that are a mixture of industry folks, other asset managers, and then some end clients, the booth traffic has steadily been increasing. So, this is a reality that clients are asking advisors questions about digital assets, and advisors are recognizing they need to have answers. We have a Bitcoin book. It's just a purple book that's, hardbound. And it almost looks like a children's book, so to speak, in terms of the way it's bound and the size of it. It's a square. And I can't tell you how many people come up and take the Bitcoin book, and then they sheepishly ask, can I take one for another advisor in my practice? And take as many as you want. There's a digital version on our website as well. People need to be educated, and I think they're a little embarrassed that they haven't done the homework yet. But I don't blame them. They didn't have the opportunity to offer their clients exposure yet. So we're here again to meet clients and advisors wherever they are on their journey into digital assets and deliver a solution for them.
So cite the website, because I think you just picked a lot of people's interest of wanting to get that purple book. So how do people get it?
Grayscale.com. You can go to our products page and our content page, or just info@grayscale.com. That's Gray with an A. So GRAYSCALE.com. grayscale.com. And, just ask. We're happy to send you one. We can send you, some to wherever you are. You can take a look at it digitally online.
And that's really what is so different is that unlike other asset classes where, everybody's familiar with stocks and bonds and real estate, crypto's new for most people, even though it's been around 15 years. And so that key word you used, education, I think is where most people ought to be spending most of their time, understanding what this stuff is, how it works, how you can make it work for you, and the amount of content that Grayscale offers to provide that education is really very valuable. So I encourage folks to go to grayscale.com and take a look at all the educational material that is available. And of course, we have a lot of it too here at dacfp.com to help you in your journey down that rabbit hole. And that, in fact, is the first question that we got from one of our attendees. How do I get started? And related to that, he's also asking the flip side, how do I get out? We've talked about making an investment into these ETFs, but talk about the liquidity, talk about the ability to exit a position.
Yeah, I mean, honestly, these products trade just like every other exchange-traded product in market. They're incredibly liquid. Spreads are incredibly tight. The ability to buy and sell a digital asset ETP, a Bitcoin ETP, is actually quite fluid and quite smooth. And, if you were to access the market directly, you would certainly be kind of paying more in spread and paying more in execution cost. Forget about any sort of cost you would subscribe to, storing it digitally yourself and any sort of operational risk. These products, like every other ETP and every other asset class, are trading incredibly tightly, really efficiently, with incredibly deep pools of liquidity. So how do you get in? You go to your brokerage account and, you in the case of Grayscale's, BTC ticker, which is the lowest cost ETP in market, pop in the ticker BTC and put your order in. I always say when trading, use limit orders, not market orders, because it just kind of protects the certainty of your execution price. And the same is true when you're exiting a position. Again, these markets are very tight, very liquid. We have deep pools of liquidity, deep pools of market makers. And we're really been pleased with the way the products have been behaving in the secondary market.
This question as well, your opinion of buying these products inside an IRA.
Yeah. I mean, listen, the opportunity to have kind of, tax deferred, status has been an incredible tool that we have seen advisors take advantage of. We have some folks that are able to, make self-directed investments in their 401ks as well when they're, available for a self-directed. So the concept of kind of incorporating these into, clients' portfolios for tax deferred status or retirement accounts has been something that has been really favorably received. We have clients that call in and ask about it in 529 accounts because they want to have a very long-term view on that. I'm not sure that there's a 529 in market that offers it yet, but we're working on that. And the reality is, people can say what they want about the volatility of Bitcoin as an underlying asset. I say it's a volatile asset that doesn't devalue. And as more and more people continue to utilize the asset for different reasons, or whether it's the government is going to have their Bitcoin reserve, or more pensions and endowments and foundations incorporate Bitcoin into their holdings. You're taking more Bitcoin out of the system, so you're kind of increasing the demand. And we all know that Bitcoin's supply is fixed. I'm no economist, but if you increase the demand and you hold supply constant or decrease supply, it has a really favorable price appreciation opportunity. And I think that's what people are really recognizing. They're taking a long-term view on making an allocation. That's why we're seeing it in retirement accounts.
Yeah. And let's face it, 2/3 of the investing public's money is inside those retirement accounts. So It makes sense to put this inside there as well. One of our attendees has asked if we could provide the link for people to get a hold of the book that you described. And yes, go to the chat here on Zoom. Michelle has posted the link directly to grayscale.com's page, so you can get it right there.
Thank you.
Robert is asking about the allocation percentages. What are you seeing advisors doing? How much are they putting of their portfolio into this?
Yeah, so we have a couple of white papers that are focused on that. Zach Pandel, who is our head of research, was formerly an economist at Goldman Sachs and has kind of come over. He's a deep enthusiast in digital assets, and we've done a lot of work on determining what the best allocation to Bitcoin is. Essentially, we have come to kind of a 1% to 5% allocation. Most people 1% to 2%, where you get kind of the best returns and risk-adjusted returns, Sharpe ratios, et cetera. Again, I encourage you to come to our website and take a look at that research report because it's really written in a way that advisors and investors are used to consuming this type of information. And that has resonated really well with our clients and has given them some comfort as to how to figure out how to make that allocation into their portfolio.
What I'm finding really interesting is that allocation is rising. When I wrote my book, The Truth About Crypto, I said 1%. That was in 2017. Or 2021. Now we're seeing people increasing that to 3, even to 5%, as you said, because Bitcoin is now being de-risked in the sense of we're no longer worried that the government's going to try to ban it,
Exactly.
that it'll be prohibited asset. So in that sense, it's been de-risked. And the higher, it's now $3 trillion roughly asset class in total, 3% of the country's assets. So on that basis, people are more comfortable doing 3 or 4, but still it's low single digits. We're not talking about 60% allocation like we do equities.
Right.
So I find that really interesting that the number is slowly getting bigger.
Rick, I got an anecdote for you. Recently, I was talking to an institutional investor that had, made a 1.5% allocation to Bitcoin, and he was having his kind of quarterly calls with his largest clients. And despite the fact that the asset was, merely 150 basis points in the portfolio, it was dominating 80% of the conversation. And so this, he was somewhat frustrated. He was having a conversation with me. He said, I'm so thrilled it's in the portfolio. He's like, we have some great assets that we've put in this portfolio. Nobody wants to talk about them, and they're far in excess of the 150 basis points that we have in Bitcoin, but everybody wants to talk about that Bitcoin allocation. It was, one story, but it's something that, is really kind of something that's dominating conversations because clients are interested in it.
Absolutely right. I see that all the time, and it's become a joke when I'm on the lecture circuit. Is that if it's a 1% allocation, why are we talking about it 50% of the time? It's fascinating how much interest there is in this.
Yeah.
Dave, let's see. One of our attendees has asked if Dave, you can cite the tickers to the ETFs that you've been referring to here on today's podcast.
Yeah, sure. So BTC is our low-cost Bitcoin ETP. ETH is our low-cost Ethereum ETP. Both of those are 15 basis points and lowest cost in market. MNRS is our miners product. So that's the equity representation of Bitcoin miners, a high correlation to the underlying asset of Bitcoin, but an equity representation of it.
Like inside it is Marathon, Riot.
Exactly. Our covered call product that's selling at the money, so this is higher income, but giving up all your upside, so to speak, is BTCC. And then our premium income product, which is selling slightly out of the money calls, so you get some of that upside capture of the Bitcoin performance in exchange for a little less income, is BPI.
Okay, so you've got 5 tickers there, and lots of opportunity for you to go exploring. Robert's got a really interesting question. At what age should we tell our clients that they're too old to participate in this?
Robert, here's the deal. Younger clients, you may want to go, full steam into direct exposure to Bitcoin. And as you're kind of getting further along in the, kind of maturity of your client's life, so to speak, maybe you want to go with BTCC, which offers you kind of exposure to Bitcoin, but is really more of a yield-oriented opportunity. I have long said, listen, you obviously have to understand the suitability of every single client, and I don't know that age is one factor where you can make a full decision. It is, a factor in a series of factors that you would consider, but I don't think there's really an age limit that you could put on Bitcoin or a Bitcoin exposure, especially when you have more options in market like we've discussed today.
In fact, I'll turn this kind of inside out. The older the client, I could argue, the more they should own Bitcoin. And the rationale for that is that if you have someone in their 80s or 90s, and they know that they're going to die with a lot of assets that they're going to leave to their children and grandchildren, it's not really their money anymore. They're now the steward of the money for the benefit of their heirs. So they shouldn't be investing as a 90-year-old. They should be investing with the mindset of that 50-year-old or 40-year-old who's going to get the money in a few years. So in that kind of warped logic, you could argue that even somebody very old for whom they personally might not be needing or appropriate for Bitcoin, if they're investing for the benefit of their heirs who will get it on a stepped up basis, why not?
Yeah, step up in basis is a nice little trick, right?
Octavio noted that you mentioned the expense ratios of BTC and ETH. What about the others?
Go to our website and we have all of our expense ratios online. I don't want to misspeak. 59 for miners, I believe 69 for both of the income products.
Matthew's asking, how do you convince the trustees of a pension fund to add these investments to their portfolios?
What I would honestly tell you is, it's just going to sound self-serving, give us a call and get experts on the phone and walk through what the concerns of the trustees have been in the past and how you can address those concerns. If it's volatility, we have answers. If it's, the certainty of the custody of the asset, we have answers. If it's, owning an exchange traded product, we have answers. I mean, listen, it just depends on the different trustees. I faced off with boards for 20 years talking about exchange traded funds. And, different boards have different concerns. But we have, a high degree of confidence that we can have a really credible conversation about digital assets, about Bitcoin, about the ETFs, about the custody, about the operations, about the liquidity. And you really have to understand the nuance of the conversation as opposed to going in and just saying, I'm going to convince you on why you should make an allocation to Bitcoin. We have so much research that we can deploy, but honestly, sometimes it's a bit overwhelming. And if you kind of parse out the conversation, it makes it a little bit more palatable and a little bit more digestible for the end client.
Yeah, it's funny. The question came up just tomorrow. I'm giving a presentation to the board of a large pension fund. They want to learn more about this subject. Are you seeing that, Dave? Are you getting more inquiries from pensions and other institutional investors who want to learn more about this space?
100%. Our legacy business was really focused on individual investors, and then large family offices is really kind of where the predominance of our client base was. As we've now brought, the ETPs online, obviously there's a very large contingent of self-directed investors. There's a very large contingent of the advised market, whether it's kind of in, large scale wealth management platforms on the wires, in the form of the wires, or independents. But like everything else, the institutions know that, the exchange traded product wrapper can be a really efficient way to seek liquidity. And, the longer term allocators buy and hold, are typically in the form of the advisors and self-directed. Those that are looking for kind of quick access or a quick trade in the form of hedge funds, or any sort of kind of more active tactical users are coming to the ETFs. And then the large scale, pensions, endowments, foundations are really starting to kind of come online as well. It's super exciting as an ETF geek to now see another asset kind of go through the same progression that we've seen with every other asset. And it's really been rewarding to be part of this journey.
Let's see. Charles is asking, because you kind of alluded to it, that, every pension investment committee and board have different concerns, different areas of interest, et cetera. And so he's asking about the hacking element, the cybersecurity piece of this. It's been one of the big fears everybody's always had. You go back to 2013, Grayscale's timing was kind of awful because it was around the era of Mt. Gox, the biggest Bitcoin hack ever. And that was, more than 10 years ago, and people still talk about it, like I just did. So how do you address that risk or concern that investors might have? How does Grayscale protect its clients with the ETFs? And in fact, Charles is asking, is there insurance for such a risk?
Yeah, so I was actually just in a diligence meeting for the first half of this morning talking about a lot of the concerns that some large-scale institutions have when making an allocation to any asset manager and onboarding any asset manager. So obviously, listen, Grayscale used to self-custody. We have since, and it's publicly, publicly documented that Coinbase is our custodian for BTC and ETH, the two tickers that I had mentioned. We have very large scale oversight of the business. We have a deep cybersecurity, team here at Grayscale. And then we also have insight into precisely what their insurance protocol is. And even furthermore, and this gets a little bit technical, but we understand exactly how, Coinbase's organization is structured, where you have Coinbase's operating business, and then you have Coinbase Trust Company. And Coinbase Trust Company, holds the assets that are in cold storage, which is where our assets, our Bitcoin and Ethereum, are held. And so, we've done diligence on that. We understand kind of the legal exposure we have and the ability for us to lay claim to those assets should something happen from a bankruptcy perspective or anything that would, potentially put those underlying assets at risk. And we're making sure that we're constantly managing wallet infrastructure so as to ensure that our clients' assets are never at one point in time unduly exposed to potential risk. Because too many assets are kind of in one wallet. So we feel like we have a very strong infrastructure. We've been doing this for a very long time. We are a very strong partner with Coinbase and feel like, our assets and our clients' assets are incredibly safekeeping.
I would venture to say that anyone who thinks that they can secure their Bitcoin better than Grayscale and Coinbase is kidding themselves. Is that a fair comment?
Yeah, I mean, look, I'm glad you said that. We feel incredibly confident about the security, our own information security, our own cybersecurity, and that of our partner at Coinbase as well.
Let's see what else we got here. There are just so many questions that people are raising. I want to make sure we get to those that are having the widest. And just to confirm, Peter's asking, your custodian is Coinbase?
That's correct.
So you've heard Michael Saylor talk often about the fact that he believes a corporation should hold Bitcoin as cash reserves as opposed to cash, which Michael argues is a depreciating asset compared to Bitcoin that is either a stable or appreciating asset. Does Grayscale have a viewpoint on that?
We have a strong viewpoint on that, and we've been kind of, paying close attention to some of the companies that have been choosing to make an allocation. Obviously, we think it's bullish for the price of Bitcoin. Obviously, we think it's another really formative use case for Bitcoin and another opportunity to kind of further validate the asset. Stay tuned. There's some products in market, and it's something that I think we're taking a very close look at to see if we can help the industry kind of take advantage of some of that in the form of a product. It could be an exciting way to kind of realize Bitcoin exposure.
Is Grayscale, this question comes from Tim, is Grayscale going to offer an XRP ETF?
So we have filed for a number of single asset tokens in the form of an exchange traded product. So kind of a further extension of our Bitcoin and Ethereum ETPs. We've filed for Solana, we filed for XRP, we filed for Filecoin. We filed for a host of these products. Obviously, they have to go through the regulatory filing process, and we're currently kind of in dialogue with the SEC on this topic in partnership with our listing exchanges, both NASDAQ and NYSE. And so, we're in that holding period. We're in that waiting period. We feel like the opportunity to kind of launch more single token ETPs is in our future. But obviously, there's a regulatory process that we have to abide by.
So what else is coming in 2025 that investors and advisors ought to be keeping an eye out for?
Well, we have are having conversations with advisors across the board as we've been referencing this whole, webinar. I think one of the things that we never really touched on, Rick, is the reality that people want, multi-token exposure. And ticker GDLC is a product that we have in market currently. It's a publicly quoted product on the OTC markets. It's also an SEC reporting company. So this is one of our kind of more mature private funds. And we have also filed to, uplist GDLC to become an ETP. And so we're, currently in that regulatory review process. And I personally have a, pretty strong conviction that that is going to be the next product from Grayscale that's going to become an ETF. Now, that's not because I have any sort of insight. It's just the reality of where it is in its 240-day review process with the SEC. It's furthest along. We think the SEC is going to engage in a constructive conversation with us. And so hopefully sometime this year, probably in the middle of the year, we think that that product could see approval. That's super exciting. An oversimplification of it is essentially, kind of the top 5 tokens that's not a meme coin and isn't a stable coin, giving you kind of exposure to, more than just Bitcoin and Ethereum. It's an exciting product, and we think it has, tremendous opportunity to garner assets and also deliver a great solution to clients.
Well, there's a lot of excitement coming this year for sure. It's been exciting since the election in the world of crypto, and I think we're going to see a whole lot more to come. And I think we're going to see a whole lot of excitement coming out of Grayscale. You've been the leader for over a decade. There's no stopping you from that leadership role, and your product innovation is second to none. So I think everyone should pay close attention to what you're doing, to sign up to get the alerts that Grayscale issues all the time. Look at the content on the site, talk to the folks out in the field at Grayscale, because they can give you an awful lot of information and guidance on how you can incorporate crypto easily, conveniently within your practice management without a lot of disruption. That could really be a benefit to your practice and, of course, to your clients. That's Dave Laval, who is the global head of ETFs at Grayscale. Dave, thank you so much for doing this today. It really has been a tremendous help to everybody.
Well, Rick, thank you so much for having us, and thanks for your continued advocacy for digital assets more broadly.
Thank you. We have some other events coming up this year. Most importantly, in June, it's Vision. This is the longest running digital assets conference exclusively for financial advisors and accredited investors. We have an awesome lineup set up. Michael Greenwald, who is the global head of digital for Amazon, is going to be keynoting, along with Catherine Molnar. She is the CIO of the Fairfax County Police Officers Retirement System, probably the earliest pension fund in the country allocating to crypto. And she'll be at the conference, along with U.S. Senator Bernie Moreno, the Republican from Ohio, who won that landmark election this past November, who has been deep in the crypto space for over a decade. He's going to be keynoting with us as well. So I encourage you to check out that QR code and join us in Dallas, June 9 to 11, for an outstanding conference that'll give you the latest on what's going on in the digital asset space. And if you need a deep dive into the new Bitcoin ETFs and the Ethereum ETFs, not so new, 14 months old now, we've got 2 toolkits for you. Comparison chart that lets you easily compare them side by side, white papers, articles, videos, podcasts, lots of info to get you the knowledge you need. QR code is right there for it, and it's all available at dacfp.com for free. And ultimately, if you want to demonstrate to your clients that you have the expertise needed in this space, get your CBDA, become certified in blockchain and digital assets. This is on the FINRA list of professional designations. It's an online self-study course. Take it at your own pace, and you'll get 18 CE credits and the ability to display the CBDA designation in your bio. Half the course is all about the tech. What is it? How does it work? And the second half is all about practice management, portfolio construction, the investment thesis, crypto taxation, how to talk about this with clients, how to add it to your practice. Thousands of advisors and professionals in the industry have gotten their CBDA. This is your opportunity to do it as well. And if you haven't yet read my #1 Amazon bestseller, The Truth About Crypto, it's a great read that'll give you the information you need to get a good understanding of how this works. So I want to say thank you again for joining us, and I look forward to seeing you at our next event before too long. Thanks.